Hello folks, welcome to another episode of the series, QuickBooks Edge. Today, we're breaking down one of the most misunderstood areas in QuickBooks Online, bank reconciliation. Reconciliation in QuickBooks Online is one of the most important controls for protecting financial accuracy. In this guide, we'll explain what reconciliation really does, when it's safe to undo, when it's not, and what to do instead so you can protect data integrity and avoid costly mistakes. Let's start with a common misconception. Reconciliation does one thing well. It confirms that transactions in QuickBooks match the bank statement amounts and timing exactly. It also locks in the beginning balance for the next period. What it does not do is verify expense categorization, fix cash flow problems, or prevent future transaction changes. In short, reconciliation confirms timing and amounts, not accounting accuracy. Firstly, let me break it clearly for you guys when it is actually safe and a better option to undo a bank reconciliation. Undoing a reconciliation can be safe, but only in very specific situations. It's generally acceptable when only the most recent month is reconciled. No reports have been sent to CPAs, management, or tax professionals. The issue is obvious, such as a missing, duplicated, or incorrect balance, and no payroll or tax filings are tied to that period. If the error is recent and isolated to 1 month, undoing may actually be the cleanest solution. Now, this is the part where it gets serious to a point that you should not undo. Do not undo if multiple months have already been reconciled, the fiscal year is closed, or taxes have been filed, reports were shared externally, or the cause of the difference is unknown. Undoing older reconciliations is like pulling a loose thread everything after it can unravel. My preferred method to undo would be undoing 1 month at a time using QuickBooks' built-in reconciliation tools. This approach removes only that month's reconciliation status, clears the R status on transactions, automatically resets the beginning balance. This allows for a clean, controlled restart without damaging future periods. One method I would never recommend is the manual method, a risky last resort. Manually undoing reconciliations by unchecking R statuses transaction by transaction is strongly discouraged. It's time-consuming, error-prone, and easy to lose the audit trail. This method should only be used as a last resort and must be fully documented. The better alternative would be to fix forward rather than rewriting history, because often, the best solution is not undoing at all. Instead, consider fixing forward. Add missing transactions in the current period. Delete duplicates and let future reconciliations balance naturally. Adjust opening balances cautiously for very old issues. Or use journal entries to preserve the audit trail. If the bank matches today, breaking past reconciliations usually creates more problems than it solves. Some common mistakes to avoid during this process are bulk undoing multiple months, editing already reconciled transactions, posting random adjustments just to force a match, ignoring beginning balances. These mistakes may seriously compromise financial integrity and may even snowball into larger reconciliation issues down the line. My final checklist for you before undoing would be to pause and ask yourself, is this the most recent month? Has anyone relied on these reports? Do I know exactly what went wrong? Do I have a backup? And can this be fixed without undoing? This checklist can save hours or even days of cleanup work. Undoing a reconciliation should always be your last option, not your first reaction. When in doubt, protect the audit trail, preserve history, and fix forward. Data integrity should always come first. Thanks for watching. See you next time.